Hello friends, welcome to our channel. Today we will learn about how to register your startup in India. In order to start a company, it is mandatory to register your startup under the Companies Act 2013. So without any delay, let's start our video. In India, there are various types of companies available under the Companies Act 2013. The most common ones are one-person company. One-person company is a company which is owned and promoted by only one individual. It is ideal for sole owners who are looking for limited liability. An OPC has to comply with limited ROC and also file regular tax returns. However, taxes are exempted for the first 3 years of business under Startup India, and they enjoy higher benefits on depreciation without any tax on dividend distribution. Private Limited Company. Private limited company is considered as a privately owned and separate legal entity from those who founded it. It includes its own shareholders, stakeholders, and board of directors. Every individual working for the company is considered as an employee. It is ideal for business with high annual turnover. Apart from filing tax returns and ROC returns regularly, private limited companies are mandated to go under an audit. Public Limited Company. A public limited company is considered as a publicly owned and a separate legal entity formed by an association of members or volunteers incorporated under the company law. The members' liability is limited to the shares held by them. A PLC is ideal for those businesses which have a high turnover and want to raise capital from the public, as they enjoy certain exemptions under the law. And apart from them, there are other companies like cooperative, unlimited company, partnership firms, sole proprietorship, Hindu undividend family, and many more. Before registering a company with government, it becomes extremely important to choose the right type of business structure for your company. Here are a few points which will help you in making your registration process easier. Decide according to your company's tax structure. A private or public limited company is required to file both income tax returns and annual returns, whereas a sole proprietor only has to file returns or income tax. A private or public company is required to get its books of account and audited annually, including expenditure on tax filing experts, accountants, and auditors. Thus, the need to choose the right kind of business structure according to the business structure becomes important due to the legal complications which are to be dealt with. A recognized and legal business type is always preferred by investors over other investor-friendly companies. Investors may be more comfortable while investing in a recognized business with a relevant business idea than a sole proprietorship. Number of owners and partners. For a business with only one owner for complete initial investment, a one-person company is ideal. For a business with more than one owner which seeks another party's investment, a private limited company or a limited liability partnership is ideal. Initial investment. For a business willing to spend less on initial investment, a partnership, sole proprietor, or HUF may be ideal. For a business looking for greater investment whose recovery is forcible, an LLP, OPC, or private limited company is very much ideal. Applicable income tax rate. The rate of income tax applicable to an HUF and sole proprietor is as per the regular slab rates. The business income is added to the individual income of the owner in case of sole proprietorship. The rate of tax applicable to private limited company, a public limited company, and partnership is up to 30%. Investors' money. Investors' trust is registered and legal entities over more profitable ones. Businesses like private limited company and LLP are more susceptible to get investments than sole proprietorship. Let's discuss about how to register a company in India. To register a company in India from INC 29 has been introduced by the Ministry of Corporate Affairs. This form has merged some processes into one process, including approving business name, application of incorporation, Thus, the process of registering a business has been simplified, and now all it requires is 7 days to incorporate a business online. The process of company registration in India consists few steps. Let's discuss them briefly. Step number 1. Acquire a digital signature certificate. An application is to be made for acquiring digital certificate of directors after logging into MCA portal. This process usually takes 2 days after the submission of documents. Acquiring a DSC will help the company to file returns online because the rule of MCA require a legitimate e-signature of the authorized person so as to ensure the security and authenticity of the returns filed. Step number 2. Acquire a director identification number. Here the business will require to prepare Form INC 29. The business will have to acquire director identification number, name approval, memorandum of association and articles of association, registered verification for office, appointment letters and declaration. Step number 3. Make a new registration on MCA portal. Here the business will have to file Form INC 29 once all the said documents are ready. The form of company formation will have to be filed, after which the incorporation certificate can be attained. Step number 4. Acquire an incorporation certificate. Upon receiving the certificate of incorporation, a PAN ID can be acquired for the company along with a new bank account. Following these instructions, a company can be registered in India. However, it is recommended to get an expert opinion before incorporating a company in India. For more such videos, do subscribe our channel and hit the bell icon for more such updates. Thank you.